kick off. Welcome everyone. I'm Immad, Akhund, founder and CEO of Mercury. Today we're going to talk about seed stage fundraising with our guest Elizabeth Yen. She's a co-founder and general partner at Hustle Fund, a pre-seed focused fund for software entrepreneurs. Previously, Elizabeth was a partner at 500 startups. She also did kind of seed stage investing. And before that, she co-founded an ad tech company called Launchbit.
Thanks for having me. I'm really excited.
Before I started Mercury, I did consider becoming a full-time investor. And one thing, I struggled with being an investor in Silicon Valley is there's so many other investors. And I think you can be a little differentiated, but often from a company's raising perspective, like money's money and they just want to move really fast. Do you find that like being like ridiculously early it does put you in a place where there isn't that many investors kind of actively competing for these companies?
I think people don't often analyze the VC business like other businesses, but you know what? It's a commodity business. To your point, money is money. My money is the same as anybody else's money. So I think over time, as we start to see more and more investors enter the fray, and now there are over 1,000 microfunds. Yeah, you have to compete on other things besides money. I think when we first started our pre-seed fund, frankly speaking, there were really no other pre-seed funds. There was Precursor, A4, and then maybe a couple of others. That was kind of it. Now there are definitely more, and they tend to be more in the form of either angel syndicates or angel operators who have a small rolling fund of sorts, or in the case of Sahil's case, a larger rolling fund of sorts. But I would still say there's tons of opportunity in pre-seed. So very rarely, especially if we're talking about founders who are not necessarily notable, as in they're not a successful serial entrepreneur. It's actually not usually competitive to get in at pre-seed. I would say we still have the problem of not enough pre-seed funders. But yeah, it's something we think about, and over time, the way we try to differentiate is through services. And one of those is, we run a growth school called Redwood School for our portfolio companies, and we're trying to more and more help, tactically speaking, help our companies get customers.
What is pre-seed anyway?
Yeah.
These names seem to change over time, and I guess different people have different definitions of it. So how do you kind of conceptualize that label?
Yeah, and this is a great question, because I think in all honesty, also VCs have different definitions of what is pre-seed or seed or post-seed or mango seed or whatever it is people call it. So for me and for Hustle Fund, we define pre-seed as you've got a product, but you have no traction. So almost all the companies we invest in have no revenue or very insignificant revenue. We do not take into account revenue as a factor, in other words. But you have done something beyond just think of an idea yesterday. So that's kind of how I would define it. I think what we're seeing at a macro scale, though, is the reason for these new stages or whatever, because they're all nomenclature, is really what's happening is as VCs get successful and they raise larger funds, then they start writing larger checks. And then if they write larger checks, then they need to, the bar to get a larger check is higher. And then that pushes up, the traction you may need. So with Series A, that was probably the first thing that happened. Instead of hitting $500,000 run rate or $1 million run rate, now maybe you need to have more traction, like $2 million run rate. And so that creates voids earlier. So that's really what's happening.
Yeah, I like to give this example sometimes. We did 2009, we did a funding round, which was at the time for my company, like relatively hot. Union Square Ventures kind of did it. It was a seed round, and it had a $500,000 raise at a 1.8 million pre, which is
wow.
which was a good hot round back then. So like, the bar has changed. When we did our first seed round at Mercury, everything about it was 10x bigger. It was a 5 million round at 18 million free, which I thought was like kind of funny how like these definitions kind of shift over time. With these like really early companies, especially ones where, it's not maybe a serial founder or someone with like a nice kind of stamp of approval, how do you find these companies? Like, where are they?
Well, going back to how, VCs should be scrutinized or analyzed as an industry like any other, I mean, we see ourselves as a B2B business, so we need to do our own lead gen. We do events like these. That way we're top of mind for people. We take applications on our website. It's like a standard lead gen play that, a SaaS company might use. And we look at each one and give everyone a response. And so actually 15% of our portfolio companies came in completely cold. And then for those that have referrals, the nature of the referrals really range. Sometimes I get referred companies by other founders we didn't invest in, or people I literally do not even know, but they just found my email address off the internet. And we take those, I think that's what it takes to compete in this day and age. But actually when we did track, because, we do a lot of tracking ourselves, since I think marketing is so important even for this business. As it turns out, the way that a lot of people find us in the first place, no matter how they end up coming in, is like over half the people initially have a touch point with us on Twitter. Like they have read something we tweet. So we spend a lot of time on Twitter. If you wonder why I waste so much time on Twitter, that's why. We're doing our own marketing.
Have you figured that there's like a anatomy of like interesting Twitter content? Like what is like an interesting tweet storm or something? Or do you just kind of go with like whatever you find interesting?
The tweet thread works really well, which is why I'm now doing one a day. And then in terms of topics, the obvious topics that you can imagine that people gravitate towards are anything around how do I fundraise? Help me fundraise. But these days, even things along the lines of how do I angel invest, or how do I get started as an emerging fund manager, have also been hits. I have to say that unfortunately, the topic that I actually really like to tweet about and have been doing more recently, even though it actually does not help as much, are things along the lines of customer acquisition. People do not care about acquiring customers. So this is where I think sometimes your mission does get in the way with results. I do it anyway, even though I know that doesn't move the needle for us, but I think it is helpful for the ecosystem if people can acquire customers better, because that's ultimately what it's all about, right?
You're doing one per day. Are you planning these out for like do you know what you're going to do next week, or is it every day you like get out mode and you got to come up with something?
Yeah, no, I don't even know what I'm going to do today. I just know that I have one that I'm going to do.
That's cool. Fred Wilson has always done this one blog post a day for almost daily for at least 10 years or something. And I always found it amazing that he can kind of keep it up and still be kind of interesting and engaging. I guess coming back to kind of these investments. So yeah, they come at you from like various directions. You take cold things. How do you, this is pre-revenue companies. You said there has to be a product, or often there is a product?
In almost all cases, there has to be a product, but I would caveat that like the products that we end up seeing are very bare bones in most cases. Not always, but sometimes it's even just a concierge type of product where it's like, oh, I have this landing page and I'm driving people towards it and getting conversions off of it, and there isn't too much else. Things like that. Yeah. So very MVP concierge level is fine.
And when you receive an inbound or a referral, like what percentage of them, just roughly speaking, do you like go, okay, this is like worth kind of having a quick conversation with this founder?
Yeah, so roughly speaking, in terms of our triaging, on 100 deals that we see, about 8 to 10 will get an interview, and then of those, 1 to 2 will get a check.
Got it. So for the 8 to 10%, what is the, I guess, like 2 or 3 like very quick kind of like green flags, like the things that you're like, okay, I have to speak to this founder, and like 2 or 3 red flags where you're like, okay, in my triaging, like this is not worth the conversation?
Yeah. So investors, and I'm curious for your thoughts, Immad, since you've done a lot of angel investing. So, there's always this old question of which is more important, team or ideas? And we do our filtering by ideas. So I'm sure we're passing on a lot of great founders whose ideas we just, for whatever reason can't get behind. And I can talk about how we think about ideas. But so ideas are the first pass, really. And I think more specifically, what in my mind makes for a good idea, I think it's having done a lot of customer acquisition myself, just gut feeling. So this is not a science. Gut feeling and totally subjective. Do I think that at scale, the lifetime value could be fairly high and the CAC could be, not creep up so much, and that there's enough buffer to play with here such that you can scalably get customers? And the answer is we will never know because we take companies pre-revenue, but that is more or less how we decide. And then additional filters are, how differentiated is this idea? Have we seen like, for example, health and wellness is a really popular category these days. It's very crowded. We tend to avoid super crowded areas because it's just really hard to tell, one company apart from the other. And I think the other thing is just crowdedness increases CAC. And so that's sort of the other thing, rightly or wrongly, like how competitive is the area, how differentiated is the idea relative to other things we're seeing. And that's kind of our first pass.
Is part of that like idea analysis, like how big the market is, either
So
existing or like could be? No, you're not thinking this is a $10 billion market, like worth it kind of thing?
usually not. I mean, I think on occasion, I'll give you an extreme example. Somebody once pitched me something related to libraries. And, I think I just felt like, well, libraries don't really have any money and they're selling to independent libraries that are small and all this stuff, right? But I think most of the time I give people a lot of credit that maybe other VCs will for market. Like I actually very rarely think about market size because I think my belief is if you can find just something to latch onto that customers like and will pay you for, you'll be able to find something adjacent, like an upsell to the same customers or an adjacent market to expand it out. But getting your foot on the first rung is the and doing it well is the hard part, and that's the part I'm most focused on.
That's interesting. I also similarly like care most about idea in that like initial filter, but I also skew heavily towards market. Like if I don't feel like it's currently a big market or it's trending towards being, I just have a hard time. I mean, getting excited about it personally as well. But I see your point. But it is hard to judge these markets. Like, I mean, if you look at Carter, it felt like a tiny market when they started, like startup cap tables, and now it's like a $3 billion company or something.
Or Coinbase.
Our Coinbase is a good one too. What are red flags where maybe it passes the idea filter, but you're like, okay, I don't have enough time to talk to this person because of X.
Yeah. So we talked about red flags at sort of the triaging stage, like if it's too competitive or not really differentiated. Once we get to the conversation, then red flags might be things more along the lines of how scrappy do I think the founders are? So this is at the point where we get to the discussion, that's when I start taking a look at how the founders think about things. And scrappiness or I don't know what the right phrasing is, burn rate combined with how much you think you've been able to achieve with so little, that matters a lot to me. And that's just a thing that I care most about. And so that is, I think the converse to that is if you have a ridiculously high burn or all these people on your team and it seems like you actually haven't really done anything with that's an automatic pass. Obviously, things like trust are really important. Sometimes people will exaggerate the truth or outright lie. That's a fine line. But a concrete example that actually happens a lot is, let's say that you are on the verge of signing a pilot, but you haven't signed it yet. And you go ahead and you tell me, hey, we have 3 signed customers. And I find out that, they have the docs but haven't signed. Like that to me is an automatic no. Rightly or wrongly. So those are kind of the things that give me pause. The last thing is probably just how go-to-market centric you are. That matters a lot to me. I know that doesn't matter as much to other investors, but I like founders who have thought, fairly deliberately about their customer acquisition and ideally have even started to do some experiments, or at least have thought through what experiments they want to do.
Someone's asking, I guess, like, what's your normal check size? What is rough valuation? And I guess how big is your fund?
So first off, my fund is called Hustle Fund, and we're on our fund 2. It hasn't been announced, but it's fairly open out there. We're an over $30 million fund on fund 2. It's a relatively new fund, so we have a lot of cash to deploy. We write a 25K check at the pre-seed level. On occasion, we will follow on, but most of the time we will not. We can make a decision after talking with somebody within 48 hours. And so that's why Immad, when I was telling you before this started, like it feels like everything's going faster because I felt like, wow, making a decision after one conversation, 48 hours seems pretty fast, at least for a VC. I know for an angel, you can make a decision often on the spot, but we do try to get people a response, ASAP after a call. And then I know nobody is really looking to raise just 25K. So one of the things that we do is we help a lot of our founders who want it at least, raise more money. So I'll just like ping my whole network, whom I think is relevant, at least to that particular company and what they're working on. And then, help them get meetings lined up. And that really is what I think, creates some of these I don't know what the right word is, crazy frenzies, but you really do need to have a lot of investors coming to the table around the same time to be able to raise a successful round and command kind of the valuation that you're looking for as well.
You said 25K on a $30 million fund. Is this whole kind of model predicated on doing kind of a big check at the next round?
Yeah, it's a great question because that seems kind of silly. So number one, we do
You'd be
write
in thousands of companies with that check size.
we do write a lot of 25K checks on this fund. We are looking to write, probably over 200 25K checks or thereabouts. We rarely follow on, but when we do follow on, we're going to follow on with 250K to $500,000 or so.
Someone's asking, like, yeah, how is Crappiness different than just being bootstrapped? Just I think is a good question. Like, what are the actual things that are scrappy? Is it just low burn rate? Like, what are things that you're like, okay, this is a scrappy person versus, not?
That's a great question and very valid considering that most of the companies we do see are bootstrapped. I think scrappiness also has in there implied, at least in my definition, something along the lines of how much you have achieved to date with what you have. So there's some sort of ratio. It's like a ratio in my mind. It's obviously not a concrete numerical ratio, but I get very impressed, for example, by founders who just, I don't know, go and do. So for example, one company that we share, Immad, is this, this company where essentially they're doing mass food distribution, and this person didn't have any background in it and didn't have any money. He just like starts calling up all these food suppliers and then just starts brokering these manual deals. And there's no technology. He has nobody on his staff. It's just him, no budget. We were the first investor in. So before us, there was nobody, but just was able to just start selling pretty large numbers of quantities, even without any other people or money. And that's an example of kind of what impresses me. Obviously, there are varying degrees of that, but and some ideas you do need people and more money. They're a little bit more capital intensive, but that's kind of what I'm looking for.
Yeah, I think it also goes to show that if they did it by themselves, like how much more could they achieve if they had a bit of money and a few people to help them. So it shows like there must be like good like market pull on that idea.
Yep.
When you mentioned like it was like the go-to-market aspect was pretty important to you. Yeah, I guess there's a couple of sides of that are pretty like relatively easy to do, right? There's like you do some ads and you have an understanding of CAC and LTV, and that's like fairly systematic, even if it's just early. Or the other side is, you've done some sales and you understand kind of your ACV and how quickly you can close. What happens for things where those two things aren't like the go-to-market strategy? I mean, like take like Clubhouse, for example, right? Like you can't,
Yeah.
I think you rely on, for some of these social things, you rely on word of mouth, and those things are very hard to explore until you've launched. But there's other types of companies as well where the mathematical response to like go to market is not as simple. Do you just avoid those types of companies, or do you think there's other ways to look at it?
Yeah, I mean, this is a great question because all of this is entirely subjective, and when companies come to us, they have, they may have some unit economics, but they're definitely going to change over time. So it really doesn't matter at the end of the day. So it is incredibly subjective. So I would say, to your point, there are certain sectors that I would say we gravitate towards. We do a lot in B2B, for example. And I think the flip side is actually we would miss out on a Clubhouse, we would miss out on an Instagram, or what I call quote pure consumer, because I think just for us, A, we don't really have a background in this as entrepreneurs, and B, I think it is. I think it's harder and a little less formulaic on how a company kind of achieves that success. I have seen certainly consumer companies grow, but then how do you get the massive growth? And those outcomes are a little bit more binary. Like if it works, it really works. But if it only sort of works, it kind of almost didn't work. And so we do, I think we do actually either miss out on those opportunities or mitigate downside risk, whatever you want to call it, from not doing those.
How do you do due diligence? Like these companies are early, you're making a pretty quick decision. But you mentioned like you're kind of checking if they've signed the pilot contract. Like, is there a way you can get this due diligence done in like 48 hours and feel like it's comprehensive enough?
I mean, I think the short answer is we don't. And on a 25K check, and that's also why we have that check size. There's really not a whole lot to dig into, and so we just write the check. I think. Go ahead.
Checking the contract, but like presumably there's like other diligence you're doing, right? Like what are the things that you kind of dig into after that first meeting?
We don't. We just literally don't. So in fact, actually, if you told me, oh, we have a signed contract or whatever with these people, I wouldn't know if you're telling me the truth. I wouldn't call up those people. Now, kind of going back to the model, like when you think about our portfolio, we have a lot of portfolio companies. Most of them are 25K checks, and hopefully we can help people get on the first rung of the ladder and help them start that climb. But on rare occasion, when we do pour in more money, that's when we have been doing due diligence all along.
I see. So you're kind of for bigger checks, you're doing, I guess, like you're learning about them as you go, kind of thing.
Yep.
I believe you do a reasonable amount of investment outside the US as well, right?
Yes, that's true.
What percentage of the portfolio is outside the US?
Right now, it's relatively small. It's about 15%, but over time, we really want to expand that because I think, honestly, that is where the best opportunities are right now.
Do you find, and I find this, it's, like for example, I've had maybe 5 people pitch me like a Mercury for Africa. And yeah, obviously they want to pitch me because,
Yeah.
I do Mercury. But I find it really hard because I'm like, I don't know anything about, I mean, specifically they're mostly in Nigeria and I don't know anything about what a Nigerian entrepreneur's pain points and like, how do I judge between these 5 different companies? Like, how do you figure out like in this country, does this make sense? And like, does it speak to that audience?
I think the honest answer is we're still figuring it out. So where we've done most of our international investments have been, I'm not even sure if you would count Canada. We do a lot in Canada, but they're basically like a friendlier US. And then we do a lot in Southeast Asia. And my business partner sits in Singapore. So I think we just have more knowledge of the region. But in some of these other areas where we have done a handful of investments, which I would call, quote, experimental to try to get a better understanding of should we hire somebody and go full force into some areas. I think part of it is to learn as we go along the way. And I think those smaller checks do help us learn what we don't know. So I think the short of it is I don't know, but that is something I think we take a very experimental approach in building out this firm as well. I think you invest a little bit and then see what happens.
Would you prefer a company that, happened to be in Europe or Africa or wherever, but was kind of attacking the global/US market? Or would you look for companies in those countries to be attacking like the local market?
We've done both. So I think for the former, what you suggest, the advantage in some cases often actually is cost. Remote teams with a lower cost structure but equal talent potentially can go further. So that's one case. But I think I would probably prefer the latter, which is I think there's just untapped greenfield in a lot of places outside the US, and that's what I have my eye on. We're doing that a little bit with this fund, but it's something we are really working towards on the next fund.
Yeah, I do find there's this like fintech ideas or a lot of kind of delivery or logistic ideas kind of make sense to be geographically kind of specific or localized or whatever. I do find it a little strange sometimes, companies that are doing like something that could be global but doing it in one space first, like in LATAM first. I'm like, oh, why don't you just do it global? The founders from there, so it makes sense. What is someone asked, like, what is a typical valuation for that pre-seed 25K check?
Wow. Valuations are all over the board. So I'll give you the range of what we have done, and I'll give you a sense. So we've done anywhere between 250K post money to 32 million post money.
Wow. Just
Part of it, yeah, part of
25K
it
at
is,
that 32 million as well?
I'm sorry, what?
It's still 25K at that 32 million?
Yeah. And I think the way we think about it, and this is where I'll disagree with a lot of VCs on this, is, everyone talks about ownership, but that totally doesn't make sense. I think it makes sense if you're a Series B fund and there are few opportunities and you want to cram as much money into one of those few opportunities. Yeah, you should think about ownership. But when you're talking about pre-seed and seed, a good counterexample is if you put $5,000 into Uber at pre-seed or seed or whatever you want to call it, you would have made a lot of money at the IPO, but you didn't have very much ownership at all. So it's about multiples. And so, I think to this question then, well, why would you invest in a $32 million valuation company? You have to get really, really strong conviction that we can still get 100x from there, which means that we're looking at a $3.2 billion outcome at a minimum.
What was it about this $32 million? I mean, you don't have to say who it was, but what were the characteristics that we were like, okay, this is, a bit of an outlier for us, but we really want to do it?
Yeah. Well, we already knew this person super well. Successful serial entrepreneur. So that's kind of where the bump comes up from. Really large idea, I guess you could say, that does require a lot of money. One of the other major funders actually was going to be a distribution partner as well. So I think it was just sort of, when you think about all the amazing things that people like to check the boxes on, this company had all of them. But I would say that it is rare for us. I would say that actually, most of the founders we back actually tend to not be serial entrepreneurs, not be notable. Actually, like I keep on harping how we're a B2B company. We've done our own customer persona exercise, and we have 3 customer personas. We have Ambitious Alan, we have Serial Sally, and we have Hotshot Harry. And if I were to do the breakdown, 80% of our founders are Ambitious Allens, and the other 2 categories are 10 and 10. So this
What's the difference between the serial and the hotshot?
That surprised me, because I think for me personally, my bias is actually towards Serial Sally's than Hotshot Harry's, because Serial Sally's, I'm okay, I think, paying up, because like these people know where the pitfalls are. They've done it before. They have some learnings. But just because you were employee number 200 at Uber, it doesn't mean you know how to start a business, right? So that's a Hotshot Harry. But nonetheless, just looking at the data, that's how it lands. We do 10% Hotshot Harrys.
That's funny. Let's see. So I think you mentioned this a little bit about how like pre-seed is changing. Do you think there's some new rules coming in for regulation crowdfunding, which is, obviously there's the small angels, now rolling funds, and now there's this regulation crowdfunding where, and partly because of the regulation, partly because WeFunder and Republic have got a little better, there is this new path where companies can go direct to unaccredited investors to raise some money. So do you think that that's going to change this kind of game, or not too much?
100%. I think going back to the point that we established in the beginning with money being a commodity, I think then the question is, okay, if you follow that train of thought, if money is a commodity and all of a sudden you're bringing in more money into the system, then people have more choices. And if people, and specifically entrepreneurs, if entrepreneurs have more choices, then who do they want to work with? And, I think that in this day and age, if you are an investor and you are not helpful, or at a minimum, you are not getting out of the way, let's just say, like if you're a pain in the butt investor, it's going to be really hard for you in the future to win deals. Because I think these new mechanisms will really change how this landscape works.
Do you think that, I mean, sure, everyone wants like a helpful investor, but if it turns out you can like click a button, raise $1 million, don't have to talk to anyone, it's relatively quick and the terms are pretty good, like, is there going to be space for kind of helpful investors? Like, or do you think people will still always care about helpful investors?
I think it's both, and that's why I mentioned both. Help, like if you're not helpful or if you're not getting out of the way. So you don't need everyone in your cap table to be helpful. Like having dumb money is fine as long as they're not calling you every day and being a pain in your side. So I think founders will want a combination of both. Obviously, it depends on what they're working on. Like, for example, if I were starting a business and somebody wanted to invest in my company and said, hey, I have this distribution channel, and as part of this investment, we're going to agree to get your product in front of all these customers. Yeah, I would sign that, I would potentially sign that deal over somebody who just gave me dumb money with the click of a button, right? So I think there are different levels of helpfulness, whatever it means. It doesn't mean actually working on the business. It could be partnerships. It could be I don't know, helping with advice. It could be helping with hiring. It could be whatever. But yeah, I think there's room for both.
This is a bit of a tangent, but like I feel like not that long ago, maybe 2 years ago, people thought about seed investing as like mostly like lighting money on fire. Whereas like suddenly, especially in the last like 12 months, everyone's like trying to get into private companies and like it's become this thing. And, everyone's like, you see this sentiment on Twitter a lot, like, why did they have accredited investor rules? Everyone should be investing in private companies. Like, what do you think changed there?
I think there are two things. So one, and this has actually changed my opinion as well. When you think about, let's just call it, I'm looking for 100x multiple or more. If you look at the data, actually, the number of unicorns in, call it the last, I don't know, 4 or 5 years has really changed. Like there's actually almost like a bit of an L, where before it's like, oh, you could count the number of unicorns on, call it 2 hands globally. But then there was 1 year, and I don't remember which year, but relatively recently, where all of a sudden the number of unicorns has really exploded. And that, partly is a function of the public markets going crazy. But I think part of it, I think there is, legit truth to it, where just frankly speaking, the opportunities on the internet are much bigger now, and you can make more money and you have a larger audience. And so therefore people can start to adjust their thinking a little bit, like, well, it's the economics can still work out because the opportunities are bigger. So I think that's thought number one. And thought number two is around actually the public markets themselves. I think previously people really liked the idea of let's invest in the public markets. We can get, anywhere between 2 and 10x multiple within a short period of time, very liquid. But then now a lot of people feel like they're companies that are just too frothy. Should Airbnb be worth near $100 billion market cap? I don't know. And so people start to go earlier and earlier. And some of these funds are a combination of both public and private funds. So they start to go earlier and everybody starts to go earlier. And then all of a sudden you have Series A funds in seed or pre-seed. And I think that's also what's happening as well.
When valuations do get frothy, maybe it's often for the hotshot Harrys or serial Sallys. Like, are there times where you're like, okay, I'm just going to have to sit this out because this valuation is just crazy, even if all the other things are a checkbox, or is it, it's a 25K check, and maybe if the market believes in, you just go with it?
For sure. No, we definitely have sat out. Yeah.
Do you regret that afterwards?
I'm sorry?
Do you regret it afterwards?
It's hard to say. It's hard to say. Well, we'll know in 5 years.
Yeah, I feel like I have mostly participated in those hot rounds, and actually often it's been worth it. Like Rippling had like this ridiculously hot round that I participated in, and now it's $1 billion company. And I also did Clubhouse's very hot round, and now that's $1 billion company as well. I feel like often these hot rounds like become self-fulfilling prophecies, at least in this market. But yeah.
Yes, in this market, I think that's true. And I do believe this market will continue for at least another couple of years until everybody runs out of money. But then what happens after that, I'm not sure. But it's definitely something we debate a lot internally. Like, momentum is a powerful thing for sure.
Yeah. This is a good question, and this does come up quite often. If you do get a no from a fund as an entrepreneur, like let's say you get that first call or something, and then you get a no. Is there a good way to reapproach the fund later on? Maybe you've made some progress or something, or do you think like a no is often not something that will get reversed?
I think it depends what the reason was, and I would definitely ask. If the no was, oh, you're too early, then you should definitely reapproach. If the no is, I can't even think of what, but like, this is not in our wheelhouse or whatever it is, then presumably it is still not in their wheelhouse.
Don't you think the reasons given are like often fabricated? Or do you think like you when you give a reason, that is like often your real reason?
When I give a reason, it is a real reason. I mean, there may be 5 reasons why we're passing, but I will give you one, and the one that I will give you is definitely truthful. Um, but I think it doesn't necessarily mean that if you solve that, like we're going to invest per se. But I do agree with you. I think there are VCs out there who give like fake reasons or half reasons, and I'm not even sure if VCs sometimes understand why they have a reason.
One thing I struggle with, and like maybe I shouldn't say this on a video, but some reasonable percentage of the time, the reason is that I just didn't like that person that much. You know what I
Yeah,
mean? Like I'm like, if I invest in someone, I really want to be helpful to them, and I feel
yeah,
like I can most do that if I feel like I like them, and they. Some people are just like a little annoying and things like that, and
yeah.
so by default, I don't give a reason ever because I don't want to only. I do sometimes rarely give a reason, but that is actually I feel uncomfortable because I can't always be truthful, so I'd rather never give a reason than like sometimes give a bullshit reason because I can't give the real reason. Do you feel that or not really?
Yeah, I definitely have. I felt that, but usually there are also other reasons that go along with that. Um, so let's just run with this example. For example, like I don't know, you meet somebody and they seem super annoying or whatever it is. Um, depending on what it is they said, sometimes I might spin that into something else. Like we have uh, concerns about how you think about XYZ based on this one comment that you made or whatever it is. Or, concerns about attracting talent with this negative attitude or whatever, like in a nicer way, right? Like there's usually some other things that are peripheral to this problem of, oh, the person's annoying and I don't want to deal with them.
That's fair. Uh, all right. Ellery is asking what you feel about competent single founders. Do you have a bias against or for single founders?
No, like we don't care. Like we've invested in a bunch of single founders and also a bunch of co-founder pairs or teams or whatever.
Do you think if there's like 4 or more co-founders, then you have a bias against it, or like even then you're fine?
I think even then we're fine. I think if I don't know, like Infosys had 7 co-founders. Like if you have that situation, then maybe I might start to wonder. But I think in general, I think it matters less as long as everybody seems to be contributing well, and then that's really what you're trying to solve for.
I feel like 90% of the companies I've seen with 4 or more co-founders have had major founder issues, but not all like have died. So, you can make it work.
And I would say that part of it comes to this like, oh, so and so's not pulling their weight kind of issue. But I would say if I haven't done the analysis on our own portfolio, I suspect that almost all of them have 2 co-founders or 1. I very rarely see people with a whole group.
Yeah,
So it hasn't really come up.
that's true. Um, do you feel like pitch decks are still like the best way to do, raises pre-seed or seed round, or do you like memos or videos or like some other format?
I like written because it's faster to process. Whether it's a Notion page, which is all the rage these days, or a deck, I don't really care. But I think a video of somebody talking for 10 minutes is challenging.
I personally find decks way easier than memos or Notion pages. I know people are really into memos and Notion pages, but I'm like, I want to see graphs and pretty pictures. No, it's just so easy to flick through it. Maybe I'm just outdated.
Well, it's funny because in the old days, people did have one pagers, right?
Yeah, it is actually a harking back to like business plans and one pages, which we got rid of.
Yeah.
Does it have to be someone that's already like 100% in, or would you fund someone that's not fully in?
Yeah. So unfortunately, I think I don't think I know any VC who will fund somebody who is part-time, including ourselves. And the reason for this is, the VC model, not only are we looking for 100x, but I think it's a bit time boxed as well. I mean, sort of a trite thing that people throw out is, can this company get to roughly 100 million a year by year 5? That's really, really hard to do. And certainly part-time, it's even harder to do. So I do believe there need to be new funding mechanisms, and I understand that it's hard for everybody to go full time, but unfortunately that's kind of how it is at the moment.
What if they're like, if we raise money, we will then go full time? Is that good enough, or do you think that's still a negative signal?
I mean, I think for us, because we have so many companies that we're looking at, like we just honestly haven't had, time to really dive into those hypothetical conversations or, if statements. So I think the answer is going to be no.
What's the best pitch you've seen, and what made it so memorable?
I don't know. They're all pretty horrible. No, and I say that actually with a lot of love and care, because actually a number of companies who have, been awesome, their pitches either were okay or not memorable or whatever. I don't think the pitch.
I mean, there must be, I guess, like, you do make investment decisions based on these pitches. So what is it about the pitches that you have found compelling enough to make an investment decision that you're like, that was like something really memorable that like did it for you?
Yeah, nothing gimmicky, but I would say that I very much tend to skew towards concise founders, like people who just like answer the question concisely.
Yeah.
So actually, the faster meetings tend to be more successful.
Concise as in like they just answer with smaller sentences, or the information density is higher? Like, what is concise here?
I guess all of the above.
I know what you mean. Sometimes I do prefer, like, sometimes people really waffle to make a point, and that does get annoying. How do you feel about investor updates? Is that something that you think is very important? Is there,
Yes.
What type of investor updates do you like to see, and how often?
I think it is really important. I think it's important even for the company's own discipline to be able to, check how am I doing from month to month. I think an ideal is monthly updates in the beginning, like pre-seed, seed, because things change so much every month. Eventually, maybe if you're later in seed, it becomes quarterly. And we absolutely would love to see those. I mean, we are making an investment in you, so we would love to kind of know what's happening in the company, even if we're not day to day.
Yeah, I kind of did them for every 2 months from the start. I just found I'd rather make them more detailed rather than do them monthly. Is there something like, is there a structure that you particularly like, or is there kind of, I don't know, headings that you like to see?
I think sometimes people overthink it. Like people want to write these long reports or whatever. I mean, I think for me, it's just, if you are at the point where you can start measuring your KPIs and working towards them, so revenue, runway, or how much money you have left, maybe CAC or whatever, and that's kind of it. Just then maybe 2 bullets on what you're doing. That's it for me. I think sometimes people feel a lot of pressure to write these long things, and really it doesn't need to be that way.
Yeah, that makes sense. Someone asked, are there business models you tend to stay away from? I know we mentioned like you avoid consumer. Are there other things that, I'm guessing, like, since you've done ad tech before, you're probably going to say you avoid ad tech. I've done ad tech before as an entrepreneur, so I avoid it. Is there other things that you think that's not a good kind of business model?
I guess never say never, but I think flipped around, I do tend to prefer SaaS, whether it's on the consumer or the business side, because assuming you have stickiness and retention, which is a big if, just because it can continue to extend your lifetime value. But that's, we've done a lot in health as well, where with insurance-based models, where it's like, okay, consumer gets something really important for free and insurance pays. So that's another model that I've really loved. and you would know better than I, Immad, but like within fintech, there are often things that make total sense where people need these fintech services, and you can take an interchange or something like that. So those are kind of the main models we've done, but
Is there a
never say
particular model that maybe other people like but you wouldn't do?
that other people like that I wouldn't do.
I'll give you an example. Like I don't like recruitment models, especially where like you get paid 10K for getting someone hired and things like that. I feel like they create kind of perverse incentives, things like that.
I think I'd be open to that. I think I try to, as much as possible, take everything case by case.
Okay. All right. This is a good question. I think actually people do talk about this, but not enough. Like, how much dilution is okay to take at various rounds? I feel like, sometimes nowadays people do a pre-seed, an accelerator, a seed, and the seed extension, and like before their Series A, they're gonna dilute it 60%. Like, what are like rough things you think are okay and things that are worth avoiding?
Yeah, this is a hard one, a hard one to answer. But I think rough rule of thumb, before the Series A, I wouldn't dilute more than half of your company. Obviously, less is better if you can get there on, call it 2 rounds, pre-seed, seed, or something in between each of those 2 rounds, and call it like 15% on average dilution on each round. Then you're maybe 35% diluted by the A. It's kind of ideal. But basically, you want to avoid something super extreme where you'll have to recap investors or whatever. And where I tend to see that is actually when people pivot and they're out of money, and so they're basically fundraising from scratch on this new idea, but they're dragging along 10 to 20% of their cap table from before. That gets hard.
I guess we'll do this one last question. Do you still have a couple of minutes?
Yeah.
Someone asked, what are the top 3 qualities you look for in a founder? I guess scrappiness is one of those top 3, maybe 2 more.
Gosh. Conciseness. That's the second. I don't know. Resilience or grit is the third.
All right, awesome. Thanks for giving us all of this great insight, Elizabeth, and kind of taking the time to answer everyone's questions. If someone is trying to get in touch with you, what are the best ways to engage?
Yeah. I mean, people can just email me. My email address is elizabeth@hustlefund.vc. Or if you don't remember that, you can tweet at me. Those are the 2 primary ways.
Okay, awesome. All right, thanks for joining us, everyone.
Yeah, thanks, Immad.
Bye.
Bye.